In today's video, we are going to discuss exactly how corporations use cash value life insurance policies, and they place these policies on their top talent, the executives, the board members, the managers at the company. So we're going to look at the specific details of how this model works. What I want to begin with is an illustration. Pretend for a moment that you own a company. You've built this company, it's very successful in your area, you've got 150 employees. Of those 150 employees, you've got a team of 5 superstars. We'll refer to these as the executive team, these team members, or your board members. Now, of those 5 team members, you've got one individual that has been with you from day one. Back when you started the company out of your garage or out of your home, they were working with you. Through the tough times when you felt like the company wasn't going to make it, they stayed with you. They were loyal all the way through. They've been on the battlefield with you, and you trust them with everything with the business. Now, if that individual were to leave your company, how devastating would that be? They know everything about your company. If there's a problem, they can fix it faster and often even better than you can. All of your staff loves working with them. Your customers love working with them. They're a key asset. So again, if they leave your company, how much stress would that cause you? How much would it negatively impact the company? What if they went and worked for your competition, say your most fierce competitor? What if they decided to go start their own business? They know everything about your company, all of the secrets, how you've built it up over the years, and now they can use that against you, or perhaps to hyper grow their business. This is a concern among both large corporations and small businesses. It always has been. And there's a number of retention strategies. How do we keep the top talent, keep them happy, keep them incentivized so they continue to work with us? But then also, how do I reward them on the back end? Some companies will offer equity positions after a certain period of time where people can buy into it. There's a number of strategies. What we're going to look at specifically in this video is the model that is used with cash value life insurance, because this benefits both the company and the employee. So let's get on into it and have some fun, shall we? When it comes to these plans, using a cash value life insurance policy, a company that is often referred to as a SERP. S-E-R-P stands for Supplemental Executive Retirement Plan. Now, this is a form of deferred compensation. It's typically a non-qualified deferred compensation plan. What that means is the payments that a company is making into this plan, these policies, is not a qualified plan like a 401k or an IRA would be. Therefore, they cannot deduct the payments. Payments to these plans are made with after-tax dollars. The industry terminology used is golden handcuffs. How do I lock in my top talent? But I've got these golden handcuffs because at the end of the road, I'm going to uncuff it and say, this thing's worth $1 million. It's all yours, Mr. Employee, Mr. and Mrs. Employee. Thank you for all of the time you put in. So the employee is rewarded on the back end. So how this works, a life insurance policy is used, or it's a number of life insurance policies if the company is looking at an executive team. I've got the company, let's call it company ABC, and then I've got executive Joe in this example. The company is the owner of the policy. The company is the beneficiary of the policy. The company is also the payer. They're funding the policy. Now, what I'll add here is the owner has complete control of everything. So if you own a cash value life insurance policy and you have cash value in there, you can access that cash value for anything that you'd like. Why I mention this is these products are frequently used by companies. The cash value is an asset on their balance sheet that if they want to access that for opportunities, investing in their business, they can do so. It goes beyond just using it purely for an employee benefit. But let's get back on track here. Company, owner, beneficiary, payer. Beneficiary, what does that mean? When death occurs, they're going to receive the death benefit. On who? Executive Joe is the insured. So the actual life insurance policy will go on Executive Joe in this case. If anything happens to him, that's when the actual death benefit is paid out. So here's how it works. We've got company ABC. They fund the policy. So the premium and PUA payments. That PUA rider is a means to maximize the cash value. These products are always going to be designed for maximum cash value with corporations. Company funding the premium. The company has access to the cash value. This is an asset on their balance sheet. And again, they can access it anytime they want, whether they're going to take loans directly against it, or if they're going to assign it as collateral to a bank or lender to get a line of credit against the cash value. But again, this is a company asset. And then we've got the death benefit. You'll notice these dollars get bigger the further down we go. The death benefit is payable to the company, and they receive that death benefit income tax-free, which you'll see at the end of this plan really provides a powerful benefit just with the flow of everything. So we've got Executive Joe. Pretend for a moment that you're Executive Joe, okay? I say to you, Joe, our company is going to take this life insurance policy out on you. You don't have to worry about funding it. You don't have to sign off on the paperwork. You might have to go through a medical exam. You might not. It depends on how many employees I'm including in the plan with the medical exam. But back to you, Joe. You have to sign off on the paperwork. I'm going to take this life insurance policy out on you. You don't have to pay anything. I'm going to pay into it. It is going to build cash value that I have access to. And when you die, Joe, I'm going to get this huge death benefit. Sound good? What are you going to say? Okay, what's in it for me? Or are you trying to kill me off here? What's going on? So for you, Executive Joe in this case, I say to you, Joe, I'm going to set up a vesting period here. And this can be a number of years. Perhaps it's 10 years. This can be up until the age of 65, or it can be performance-based. Companies can set this up however they want. Company IBC, I would set this up in this particular case if I'm the company and you're my employee. But let's say it's until age 65. Joe, if you stay with me until age 65, you're going to receive a retirement benefit, almost like a pension. However, if you don't stay with my company until age 65, if that's the vesting period we select or agree upon, there's no retirement benefit that you receive. Now, if that's the case, I can actually transfer that policy to another executive, but you need to be vested before you receive that retirement benefit. What that means is if we set age 65 as the vesting period, Executive Joe, you in this case, must remain with the company up until age 65. Again, all companies do things differently. Could make it 10 years, maybe it's performance-based. So if you fail to vest, you do not get the retirement benefit. Now let's assume you stay with the company, because the longer you're with the company, the harder it is for the executive to leave, because they're going to walk away from that retirement benefit. And you know upfront exactly what that benefit will be. So let's assume in this example, the retirement benefit is going to be $50,000 per year. And I'm going to pay you that once you hit age 65 up until the day you die. Let's assume it's age 90 in this example. Now, from the company's perspective, I'm paying you that $50,000 per year from the cash value. Because once you, Joe, Executive Joe, retires, are you still generating revenue for the company? Probably not. So do I want to take that from cash flow and then still compensate you? Probably not. I don't want to harm my revenue that way or my profit and loss statement. So what most companies do here is take distributions from the cash value. That's how I'm going to pay you that $50,000. When the $50,000 is dispersed from the cash value, remember that the company owns the policy. There's no taxable event to the company upon this disbursement. So I can take a withdrawal up to my cost basis as the policy owner, or I can take a loan that I do not have to pay back. So I take that $50,000 when I say I, the company, and I pay that to Joe. That can and often is taxable to Joe because it is booked as a compensation expense. So the company can book it as a compensation expense, which does create a tax benefit there. However, it is taxable to Joe. Depending on how one wants this arrangement to work, some companies will set it up where they want their executives to receive a net of $50,000. They'll say, hey, we're going to pay you $65,000 after taxes that should net out to $50K. And then sometimes we'll calculate it to the dollar, to the penny, I should say. But main point here is if Joe meets the vesting requirement, stays with the company, he's going to receive that $50,000 per year from the company. This is a deferred compensation plan. This is in addition to everything else that Joe has done. 401ks, real estate, stocks, bonds, his other investments, and retirement planning, his personal planning. This is an additional benefit. So that's great. Here's how it ends. Eventually, what happens to Joe? Eventually, he'll kick the bucket. When he does, We want to make sure that this plan is designed where we recover all of the payments. So a lot of large Fortune 500 companies will do this. Small businesses will as well. From a long-term planning perspective, there's a ton of value here. Here's how it works. So we've got here recover payments. If I'm funding a policy on Joe, say at $100,000 per year, and it could be $10,000 per year, the number is irrelevant. Let's say it's $100,000 per year for 10 years, a total of $1 million. I've paid that $1 million into the policy. What I want to make sure of is when Joe dies, that I recover those payments, the $1 million. We also want to account for inflation. In the next video, we're going to go through exactly that in a specific model of an executive team of 5 members. But we want to make sure that we recover the full costs because that death benefit comes back income tax-free to company ABC in this case. So here we go. Executive Joe, I've got the life insurance on him. When he dies, the death benefit is paid at his death. The death benefit, those proceeds go completely income tax-free to company ABC. Now, another question that comes up sometimes with this plan, because it works beautifully, I lock in Executive Joe. That's really where I'm going to drive the revenue. I've got access to the cash value all the way through. So let's say I start this plan when Joe's 40 years old. That's 25 years before he receives the benefit. Does that mean I just have to let the money sit and grow for 25 years? That's where corporations and especially small businesses are turned off. No, not at all. As I build that cash value, it's an asset on the balance sheet that I can access it. Often you'll see companies assign the cash value as collateral to obtain a line of credit. The only important thing in this particular case is to make sure at age 65, if Joe has remained with the company, that I've got that cash value restored so I can then begin to pay him the $50,000 per year. If not, I might have to pay it from company profits or revenues because remember, I've got to honor that agreement. So if we're going to access the cash value, that is something we monitor closely and make sure we discuss each year during review meetings. A question that comes up sometimes here is what if Joe leaves? So let's say Joe has this benefit, but he says, you know what? I've just lost my drive. I want to go do something else now. I appreciate all of the benefits. I understand that I'm walking away from this 50 grand per year. Maybe it's $150,000 per year, however we set it up. But he says, it's not about the money. I'm going to go do something else. What happens in this particular case? This question comes up quite a bit. Well, these policies will always have a transfer of insured rider attached, or I should say, we'll always attach this rider. What this allows for is if Joe leaves, we're going to have another executive or employee at the company, which I can then transfer that policy onto the new employee. So for example, let's assume that his replacement is Jill, and let's assume we started the policy on Joe at age 40. Check this out. This creates one of those, I didn't know that moments. Let's say Joe leaves after 15 years. Which he'll be 55, but he started the policy. Let's assume it's in 2020. 15 years later, it's 2035. With me? He leaves. You've got Jill now. You're going to transfer this 15-year-old policy, which is over the initial insurance expenses, the cash value's there, the death benefit's there, it's compounding. So you don't have to start a new policy and go through new expenses. You've got Jill. Let's say when she comes on board, she's 40. In 2035, that is. The policy was started in 2020, 15 years ago. So this policy will actually be based on Jill's age 15 years ago, which would be 25. She'll have to go through underwriting, and the policy will have to be repriced, but it will be a 15-year-old policy. The beauty about that is I don't lose any time. In a case like this, it's not based on her age of 40, it's based on her age of 25. A lot of professional sports teams do this. When they're trading players, instead of just starting over with a new policy, they'll transfer the life insurance policy to the new rookie or new team member that comes on board. But it's pretty cool when you look at it, just what you can do with life insurance, where companies can really take advantage of it is the fact that they don't have to go through a new policy and new expenses again. Because what's the worst part about any life insurance policy? right off the bat. The first year, I've got negative equity. You'll see that in the next example as we begin to look at the case studies, the next video, I should say. But if I can utilize that transfer of insured rider, boy, can I really make this policy hum over time. Hope you enjoyed this video. If you did, please hit the like button, subscribe for more, and we'll see you in the next video. As always, hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.